Hey guys, Frank Curzio here, and welcome to a special Wall Street Unplugged where my opportunity to give back. We saw amazing demand for our first ever town hall event, live webinar, live stream, and I asked you to write in your Q&As, and I took it over an hour to answer some of your questions. We were amazed by the demand. We were amazed by how many people asked questions where I thought it was going to be 50 to 100, and it was close to 500. So a lot of you wrote in, a lot of you attended the event, and more than a third of you stayed for over 2 hours and 15 minutes, which statistically, when we look at this stuff, it is unbelievable, right? But it just shows the times that we're in because it's very confusing. And reading through your questions, I saw that. Unfortunately, I couldn't get to every single one of them. But in this special podcast, I'm going to get to a lot today because a lot of you asking about Money Flow Trader. You met Ginia. I created this newsletter 2 years ago to show investors how institutions, how experienced investors play the downside and hedge themselves in the market and do it conservatively, right? Not like shorting Tesla, where if you're wrong, you're going to be sleeping on a park bench. But if you're wrong, it doesn't matter if it goes to 300, 500, 900, 3,000, where you're only going to lose the amount of money that you put in through conservative option strategies. So, and I think that's why it was such a success, because I know a lot of you are nervous. I'm nervous with the markets trading at, astronomical valuations at a time where we're seeing, GDP unemployment right now at levels not seen since 1930, right? The Great Depression. So for me to give back here, I want to answer some of your questions. I'm going to get to as many as I can. Again, I'm not going to get to the rest of, 300, 350 or so, but I'm going to try to just zip through this and answer as many as I can. Again, this is for you. So let's start with a question from Keith. He says, if companies are removing guidance, how does that impact the calculations of forward earnings? It's a great question. So you get forward earnings from the analysts, and when these companies report every quarter, they give that guidance, and analysts could estimate whether they believe that or not. And the consensus estimate comes up with that number. This is why I'm so nervous about the market. In my presentation, I said earnings are trading at 23 times forward earnings, right? This S&P 500. That's based on the analysts only expecting a 20% decline in earnings year over year, which is insane. I mean, the whole entire economy is closed. You're looking at even Apple's earnings are declining. You're seeing Disney's earnings went from 90 cents to 60 cents, a 33% decline. And you're going to see those numbers continue as we open the economy, but still, you're not going to get back to normal for a very, very long time. So even taking a conservative approach of a decline in 20% of earnings year over year, last year was $165, a 20% would mean it would be $127. So very simple. If you take the S&P 500, which is at 2,900 today, and you divide it by 127, you get to 23 times forward earnings. To put that in perspective, we were trading at 19 and a half times earnings pre-coronavirus. So that's how crazy things are and expectations are. Good question, but that's how you really come up with guidance. So for me, it's at least a 20% decline. I think it's going to be more like a 30, 40% decline. You could probably see $110 in earnings. That means right now at forward earnings, we're trading at pretty close to 26, 27 times. Right, which is pretty crazy. So it's super expensive, and that's why I'm worried. That's why I was worried the market. You saw that when I did my presentation, but that's a good question, but that's how I come up with the calculation for forward earnings. Next question is from Max. He says, is it the time to invest in U.S. oil, or should I wait? I saw Devon go from 40 to 5. I mean, some of these moves were crazy. What I would do is, I believe 18 months from now, we're going to see $40 oil. $45 oil. And there's a lot of companies within the Permian that could actually produce and make money at those prices, even if it takes 24 months. So what you want to do is you always want to look at the risk factor. What if I'm wrong? If you're wrong and it stays here, there's a lot of companies going to go bankrupt. Those aren't the ones you want to buy. You want to buy the ones that have a lot of their production hedged this year. That would be Pioneer Energy. Devon is another one. Or you can stick to the big guys, although I do think they may suspend their dividends if this lasts throughout the year where we see prices under $30. I don't see how they're going to pay the 7-8% dividends. It would be smart to cut that in half and use billions to actually purchase all these assets that are going to be trading at pennies on the dollar than pay a 7% yield, which is crazy. I'm saying that because both Chevron and Exxon said that they're committed to their dividends, and Royal Dutch actually lowered the dividend and suspended it. So I would focus on those. Laredo Petroleum is another one that's hedged. Remember, if oil surges, these aren't going to do as good as those who are not levered to the price of oil. But this is a middle road, which you want to play from a risk reward standpoint. You want to get aggressive, buy some of the crazy names, and if oil goes higher, these things are going to triple, go up 4 or 5x. If you want to play it, very conservative, Exxon and Chevron, or if you want to play the middle of the road, I like Pioneer and Devon. Aaron asks, wondering about the junior gold mining stocks you mentioned on your podcast. Also, when to buy gold stocks in general. I mean, I covered this even during the presentation, Aaron, and you have to get into gold right now. I mean, it's never been this great for gold ever. So, I joke around and say the gold bugs and the people I've known have been pitching this for 30, 40 years, and gold's going to be reserve currency, dollar's going to lose its reserve currency status, it's going to crash, all this stuff. The dollar's not going to crash. It's always a safe haven in the world. It's always in huge demand. During every single downturn, there's a reason why the dollar goes up. Everybody rushes into it. They don't really rush into gold as much. This isn't about a safe haven. This is about massive, massive, massive amounts of money printing that's not going to stop. I mean, $3 trillion we printed already, which is crazy. So it's going to go up to $5 trillion at least. We're not done. And that's just the U.S. I mean, low rates across the world, just the yield is so low, which is really big with gold because when you buy it, you don't get a yield. So, if you're looking at treasuries or if you're looking at a 10-year and say it was at 2%, 2.5%, you can get a risk-free rate of return of 2%, then maybe people would park money there. But now gold is just the perfect environment right now. I think junior gold stocks, it's good to take a shot on those. Buy the large caps. You need to buy Newmont, Barrick. A lot of these companies probably reported, Newmont's doing fine. But remember, coronavirus, some of their mines are offline. Once they come back online, these guys merged, the Newmonts, the Goldcorps, just the major players. They did what the oil companies did, 20, 25 years ago when Exxon merged with Mobil and they created these, huge Texaco, Chevron, all these big, massive companies during a down market. And now they're going to be enormous. And there's going to be a lot of M&A activity, which is good for junior miners, but have exposure to gold, not just gold through stocks, because a lot of these companies are run terribly. I know I'm in this industry a lot, but overall, you want to buy some of the names that I mentioned. I mean, I don't want to give too many away because they're in my newsletters and people pay for that. But I would have exposure to I explain during the town hall, the 5 things I look for. So just make sure they're cash rich, they have good projects, good management teams to start, and that's the best place to look for junior miners and also large cap gold plays, and also have exposure to gold in general. Let's keep going here. Now, Thomas says, how long do you think it would take for oil field service companies to make a recovery? It's a little different, right? So this is really tough. I mean, you're looking at the rig count. So the oil service, Exxon would use, Baker Hughes, or they would use Schlumberger, Halliburton, Weatherford, if they're still around. I know that they're close to going under. But, these companies make money when you see more drilling activity. And if you're looking at the drilling rigs, I think it went from 800 to 300, and it's going to go much, much lower. Right? Nobody can really make money at these prices. And when you do that and all the services that go into these things, they're pricing in. These things are down tremendously already. They're pricing in a lot. But I think you're better off buying the oil companies who are already producing oil, who don't need to drill to produce oil right away. So they can produce as prices go up and then decide to drill. But I think that's a late stage. Those are late stage recovery plays. Again, it's all based on price. I mean, if these things go down to below book value, below cash value, which they won't, it's different. Then you could buy them and say, okay, there's a lot less risk in them. But that's like a secondary play. After you see oil come back, and it will if it goes to $56 a barrel, whatever, 4 or 5 years from now, you're going to see the small caps. You're going to see the oil drillers do very well. The big guys do well. But those service companies, you need drilling, and there's not a lot of drilling going on. I don't see a lot of drilling going on, at least until prices get over $45. Next question from Stanley. How do you know when it's better to buy options and when it's better to buy the underlying stock? It's a good question. We talked about that money flow trader. And that newsletter is structured with Ginia where she's buying puts and betting against stocks, betting against sectors. And I think it's a fantastic opportunity for that newsletter. Yes, we've seen the market roar higher, but we saw it so quick, which is a good thing for this newsletter because you're only going to lose. She's buying long dated puts that are 9 months, a year out. So you don't really care too much about what happens in the short term. You're not going to see 35% moves all the way on the upside. But a lot of individual names are extremely expensive. Now, how you know when it's better to buy options? If you're going to hedge your account, if you want to put 10% of your portfolio in some of these strategies, but you just got to be aware. Options have time, right? The time value. So it's important because if you're buying a stock, long term, whatever it is, JP Morgan, and you're like, okay, banking's, they're not going to issue dividends for a while. They're not going to have buybacks. But you know what? I really like JP Morgan. It's going to be around forever, the biggest bank in the world. I'm going to be in it for 10 years. Then that's different. But if you believe that hey, you know what? And I'm under this too because I love Citigroup, and we got out a really great price. We did very well in that position in my Curzio Research Advisory. But for Citigroup, my thesis was based on them buying 30% of their float back, which is incredible. I mean, earnings are going to surge even if they don't see more demand, right? Even if earnings or they're not generating more money just by simply bringing that share count down. And they were increasing their dividends, and they paid higher than the S&P 500, so than the average dividend. So when I look at that thesis is no longer there. So maybe without that thesis, I wouldn't be buying large cap banks. So maybe you want to buy puts. Maybe you say, okay, for the next year or two, if these guys aren't paying dividends and they're not buying back their stock, and you have interest rates low, because banks do terrible when interest rates low, right? They make money on the spread when interest rates are higher. Then it's a good play to use options. You say, okay, over the next year, these guys aren't going to be generating those profits. They're going to see even more loan losses, all this unemployment, companies going out of business, just the funding that they did, more loan loss provisions and stuff like that. Then it's better to use options. And that's why Money Flow Trader is the way to go. So let's get to the next one. It's Eddie. He says, hey, Frank, for stocks that are long-term holds but may experience another drawdown, is it best to sell and wait for reentry, or just hold your long-term convictions through this? It says, for example, like Microsoft. You own Microsoft, good for you. You're doing great. If you're a long-term holder, don't ever try to time this market. It's impossible. And I said that too because we're fortunate. Saw the writing on the wall, explain that to you of why you should take profits in February. And then when this market crashed, I actually went on my podcast, Wall Street Unplugged, and I said, guys, look, it's very rare for someone to call a top or a bottom, especially one that doesn't call a bottom every single time or top every single time every of the day of their career, right? Or perma bulls or perma bears. I said, we got that right. I said, it's going to be very hard to get the actual bottom right because you can't. But you never know the timing of the markets, right? You'd think that the market should have came down a lot more or stayed down 25% plus, but it roared back. You saw more money entering the system. And again, this is a short-term thing, but I know how difficult it is, guys, to really look at the markets and watch TV and CNBC, and people say the market's going to crash. You got to go long, 30. It's going to go up another 20% for me. It's really crazy, right? It's a big entertainment factor, and sometimes people get on TV, they don't realize that investors like you, individual investors, are listening to every word. And these guys are just, without even research backing it, just saying, hey, you know what, the market's going to go up or it's going to crash. And it's just, you have to be careful. So long-term investors, answer your question, especially like if you're owning like the Microsofts, the Amazons, hold them long-term because it's impossible to time the market. So don't try to go in and out. As a trader, it's a little different. So as a trader, that's, you can get in and out of the market. You could short stocks, use different option strategies, even the ones with Money Flow Trader. So, but I wouldn't wait try to time the market and coming out and then coming back in. It's too crazy, especially for like a 401k or a retirement plan. Next question is from Mark. He says, Frank, what about shorting the housing market? Terrible idea. Don't short housing. I think this is going to be one of the booming markets. I think commercial real estate's in big trouble, especially in New York, right? I mean, New York is, think about it. People are working from home, and companies are realizing they're getting the same productivity from people working at home compared to people at the office. What does that say for New York real estate? What does that say for real estate in all the prime cities around the world? I mean, the amount of money they pay for real estate is incredible. Imagine you can cut that in half. I mean, it's unbelievable. You can see hundreds of millions of dollars, for some of these companies that have operations in every single city, or 40 different operations in cities all over the place. It's the amount of money they for leases, rent. But individual houses, you're seeing interest rates are going to be low for a very, very long time. I'm hearing it on my end. I'm hearing it from people that write in, frankcurzioresearch.com. This is why we get a good gauge on Wall Street Unplugged. We get real-time data from all of you, up to over 100,000 downloads on the podcast every month, which is incredible. But a lot of you are encouraged to email. And I have to tell you, 95% of the people that are talking about housing are saying how home prices are going up in their neighborhood. All these houses that were for sale, people were worried. They put it on hold. Now they're buying right away. Again, in a low interest rate environment that's going to stay like that for a very, very, very long time, that fuels the housing market. It really does. So don't short the housing market. People have a lot of equity in their homes too. So I know it's going to be hard to tap that equity, but this is a totally different scenario where people were able to buy 5 houses without putting $1 down. You need a library card. It's not like that now, right? It was totally crazy in 2008, 2009. So it's actually really hard, even if you own one house and you're an accredited investor, it's not easy to buy a second house. It's very difficult. It's not easy for the banks to give you that loan. I went through that personally. I had to pay cash for a home that I bought my mom. So I wouldn't short it. I would be buying this market. I think this is a good market to buy. Some of these are still trading off their highs, home builders, but you're going to see an incredible boom, I think, in real estate because we have low interest rates. And I'm thinking, real estate long term, maybe a year, 18 months will be difficult during the coronavirus, but long term, and we're keeping interest rates low for a very long time. So if we do, that should fuel or put a bottom under the housing market. So I wouldn't really short housing stocks. This is a different crisis, guys. This is a different crisis. It was a banking crisis. It was a leverage crisis. This is a crisis of supply and demand. You just basically shut all the businesses. It's not like people aren't going to go out and spend again. I just think it's going to take longer for all these businesses to get back to 100%. Everybody thinks it's going to happen in 6 to 9 months. I think it's going to happen in 18 to 24 months. But once it does, we're going to be in a pretty good economy. It's going to provide tremendous opportunities. I think housing stocks are those opportunities. Let's get to the next one. It's from Joe. It says, Fred, when is this market going to go down? Just seems like it goes up every day without let up. Did we miss the boat? You didn't miss the boat if you're following my newsletters. I mean, we were picking away at a lot of stocks that are doing fantastic right now. And it was the stocks that I could see where earnings are going to be. I could see demand. These are companies that are hiring. These are companies that are raising their dividends. Not talking about speculative companies where you're looking to buy some crazy biotech and the possibility they can get, phase 1 approval for the coronavirus vaccine, which it's still going to take a year and a half to go to market, and they got to pass phase 2 and phase 3, right? So there's a lot of companies that we didn't have to speculate on that we put into our portfolios, my portfolios, and they're doing very, very well. So, if you're following my newsletters, you didn't miss the boat. When is this market going to come down? It is going to come down. I mean, it is. I mean, it can't stay here. I'm factoring in all the stimulus at 24 times forward earnings, and Disney is a good example. I mean, Disney came out and said, in their last quarter, it was a disaster. They said they can't market Hulu internationally because they don't have money. They suspended their dividend for 6 months. They said they really don't know how they're going to bring the parks online yet. They still need to rule, the rules in the U.S. They're going to bring Shanghai. They still don't know the rules for Shanghai either, but they're going to open up at 30% capacity. But there's going to be a lot of people that want to go. So what 30%? There's so many questions. In Shanghai, I think they said they're going to take their temperature and everyone has to wear masks. Are they going to be really close in lines? There's going to be separations in lines because at Disney, those lines, I go there, I'm in Florida, those lines could be like a mile long, and I'm not even exaggerating. If you have social distancing at 6 feet, you're going to get out of the car in the parking lot, and that's going to be the line to go see whatever character you want. I mean, that's how crazy it is. So Elsa or Frozen, all those characters, the lines are crazy. If you have young kids, you know what I'm talking about, young girls especially. So, but the point was with Disney, it was an absolute disaster. And yet the stock went up a little bit on that news. It's trading at 45 times forward earnings, the highest valuation in 30 years, maybe the highest valuation of any stock I've seen that's not expected to grow over 24 months. Tesla's expensive, but they're growing. Salesforce is expensive, but it's growing. I mean, you're looking at a lot of technology companies. They're growing, right? They're expensive, but they're growing. Disney's super expensive and not growing. It will. Eventually numbers matter. And that's why with Money Flow Trader, which I really like, is betting a year out on Disney makes sense. Betting the next 2 months doesn't. Because they're in streaming, and streaming is great. They can't make money on streaming. That's why you saw revenues go up and earnings get blasted. Because the more subscribers they add, the more money they're going to lose. It's just a high capital intensive business that, I don't know what, streaming is great for you. It's great for me, for businesses. Just to put in perspective, you're looking at Netflix is spending $17 billion on new content, and they generated $21 billion in revenue last year. They have 180 million subscribers. You're looking at Disney at 60 million, 55 million. Even when they get to 100 million, their projections are they're going to spend $2-3 billion for content, which is insane. How could you compete? It's an industry that has no pricing power. So when I look at this market, I look at things like Disney, I don't know when it's going to go down. I thought it would go down sooner, but in a market where the government is really, providing a bottom, but not only that, you're seeing momentum at a lot of names, and you see more excitement now because people are like, oh, I don't want to miss the boat. So I don't know what's going to happen in a month or two, but I know in a year from now, I'd be extremely surprised if Disney's not down at least 25, 30% from this level. And when you play that through option strategies and buying puts, I mean, if you're seeing a 20, 30% decline, it's not that you're shorting it and you're going to make 20, 30%, right? And if it goes higher, you lose everything. You make 2x, 3x, 5x returns, which Ginny has shown in Money Flow Trader. So, that's why I've come to this a lot, because this is a bearish thesis. This is the reason why I created this newsletter 2 years ago. This is why this is the number one selling newsletter that we have. It's a strategy that I'm using, and for me, I wanted to pass that on to you. It's why I offered a discount for this newsletter. Again, not all of you expect to take it, and I'm not looking for you to buy it and be pissed off 2 months from now. This is a necessity. People need to learn these strategies. They're very, very simple. And if you do, you're going to be able to hedge your portfolio. You don't have to worry about these massive ups and downs. When it goes down, you're going to make really good money, 2, 3, 4 times your money that you put into some of these things if you're right. And if the market goes up and you lose money in that trade, you're hedging yourself. And that's what you want to do. So instead of being 100% long, 100% short, this is a way to hedge yourself. It's a way to bring institutional research and institutional strategies to mom and pop investors, which I haven't seen a newsletter like this. And for me, it was 2 years early and it didn't do as well because the market surged higher for 2 years. But it was a little bit early on this. I just knew eventually the market was going to come down after the longest bull run ever. And now, I'm happy for Ginny, and she's making her clients a lot of money. And I think it's just in perfect position right now. So when is it going to come down? I don't know, but I could tell you that I'd be extremely surprised if we're not at least 10, 15% lower in the S&P 500 a year from now. And that could happen in 3 months. That could happen in 6 months. That could happen in 9 months. And if you're using these strategies and you have to catch one, this is going to provide 4, 5x, 6x gains. Which Ginny has done. With Starbucks, 500% gains. Tifa Pharmaceuticals, she's got like 500 or 600% winners during the market when it's a complete downturn, which is really cool. So let's move on. The next one is from Alan. He says, Frank, do you believe, as Ray Dalio does, that we are entering a 1930s style depression? I don't think so, because what's causing this and what we're seeing here is we're being forced to stay home. There's still demand. People are still, we do have unemployment, and I get it, but we're seeing a shift in the economy. If you notice, the NASDAQ is up this year, which is crazy, right? But it's not so crazy when you think about it. Yes, there's expensive stocks that are technology, but they're actually putting together amazing earnings. They're offering guidance, a lot of these companies. Because you're seeing everyone shop online. You're changing people's behaviors. You're forcing them to change, and they're starting to realize, wow, this is really cool. I could buy all my stuff on Amazon and just make sure I get it every single month. And believe it or not, there are a lot of people in the U.S. that aren't on Amazon. Shopify, you're seeing, software companies. You're seeing just companies, the Zooms. Now, you could do conference calls with 30, 40 people. You could see everybody. You don't have to be in an office anymore. So I don't see that type of depression where everything gets destroyed. We do have super low interest rates, and we do have a government that's absolutely out of their mind. You don't have to agree with it, but invest accordingly. Don't put your emotions, only your emotions get involved. They're going to spend trillions of dollars. If this thing goes down another 30, 35%, they're going to spend trillions and trillions and trillions to backstop. They're going to take equity stakes in every single sector. They'll do anything it takes, especially during election years. So, what will hit the fan? It's not a short-term problem. It's a longer-term problem with the Fed's balance sheet. But we are going to see probably negative interest rates, even in treasuries maybe, super low interest rates. But I don't see the 30-style depression. I just see incredible volatility. And it's going to be big winners and huge losers because of this shift that we were forced forced on us to stay home. And how do we do things now? Just think about schooling. How many people are going to start taking online courses for college now that they've done that and say, wow, this is pretty cool. I could stay home and do this. And, so it's a lot of businesses that are going to thrive, and there's a lot of businesses that aren't going to thrive because of this. And so I don't know if we're going to see a 30-style depression. We're going to see numbers similar to that, especially over the next 2 quarters. But I'm hoping when we see the Amazon's hiring 100,000 people, Walmart's hiring tons of people, and these technology companies, hopefully they'll pick up the balance of everything else that's going lower. But it's just a shift in productivity and a rotation in assets right now. Lima says, how much money should I have available to invest in Ginny's Money Flow Trader newsletter picks? The beauty of this service is anyone could use it. We showed at Microsoft it was just $200 for one position. Just know that you could lose that $200. If you have $10,000 and you put $1,000 in each situation, you need to know one of these things, and you're probably easily going to make 1x if one of these stocks come down 20, 25%. And I explained this during a town hall event. So you don't need a lot of money to use this newsletter, which is good, but you don't want to put, say if you have 10 grand that you want to invest in stocks, don't put it all into this newsletter. This is a newsletter used to hedge yourself. And I'm saying that even though, again, I'm being as honest as I can with you. I don't want you to put all your money in this newsletter. For me, I'm looking at it. Here's your 401k. Here's your money in stocks with my newsletters. And I want you to be able to hedge yourself through strategies that institutions have been using for decades to protect themselves and to make a ton of money, because we know markets go up and down, stocks go up and down. And since 2009, they went straight up. And now they've come down, right? We've bounced back, but you're going to see a lot of these stocks, the volatility, 10, 20, 30% moves in these stocks around quarterly earnings. Quarterly earnings are going to matter. And, Ginny's a forensic analyst where she's going to dig deep like we did. Like I show you with Disney and Apple, and why, these stocks trading at these astronomical valuations don't make any sense. But the good news is it's only the amount that you put in. And that's why that's important. So in other words, if Ginny is wrong, and she's going to be wrong on certain positions, maybe the market goes against you, whatever, you don't have to worry about getting blown out as if it's a short. What do I do? Oh my God, Tesla went from 300 to 400 to 500 to 700. What am I doing? You get those margin calls, and next thing you know, your $100,000 account is zero. It's not funny. I've seen it happen. So with this, it's you're limited to the amount. So that's why we structured the newsletter where for Money Flow Trader, you can just put, you're only going to lose the amount of money that you put into every position. VNet says, let me see here. All right, that's right. So he says, what? This is great. I'm going to translate here. So he says, how do you get so much knowledge and updates? What are some of your favorite sources? I'm answering this question again because I answered it during the live session. And I said briefing.com, fly on the wall. Those are two services that are probably like $600 a year. Fantastic, unbelievable. Just, they'll provide earning calendars. They'll provide updates when these companies report earnings, all the news, but it provides it in a way that it's not thrown at you where it's so hard to read. Like you open a Wall Street Journal, you're like, whoa, sometimes, as a new investor, you may get overwhelmed. It's just like bullets. And then you could hit it and it'll expand and tell you more about the story and a link that you could, read. I mean, these are two good sites. I don't get paid by any of these sites. A Wall Street Journal is good. I have access to tons of sell-side reports, so I know what the analysts are thinking. And the most important thing that I do, which I know none of you do, because you'd be crazy to do this, is I watch a lot of TV. Now, you watch a lot of TV, but you probably watch talk about news. If you're a Democrat, you're watching CNN. You're watching MSNBC. I don't want to get into politics, don't email about it. But if you are Republican, you're watching Fox. My job is to watch them all because that's how I gauge sentiment. And then I look at the sell-side analyst reports and see what they're projecting. The sell-side reports are important. It's the most important thing as a research analyst because that's the consensus. So when you go on TV and say, whatever stock, XYZ stock is going to earn $1 and they earn $1.05 and they say, well, they beat estimates by 5 cents. That estimates is the analyst estimates. And if you could prove, which I've been doing for 25 years, if you could prove that that number is wrong on the upside or the downside, that's how you come to your positions. That's how you know if sentiment is baked in. That's how you know, like with Disney, I don't think earnings have come down enough. I mean, it's 40 times earnings. I think it's trading more at 60 times earnings. They may earn $1 next year, $1.15 next year. I mean, it's crazy the amount of money that's coming out of this company. Again, they're furloughing their employees. They haven't even brought them back yet. So when I see, those type of expenses for these companies, it's pretty crazy. I mean, so for me, my job is to watch and read like CNBCs and just get a general idea of which way sentiment is going. That's one of the reasons why I like the airlines. Everyone's like, Buffett's out of them. Should have known Buffett was going to come out of them. He lowered his stakes below 10%. This way he doesn't have to report within 2 days. He could report at the end of the quarter. For me, I knew that he was going to be out of most of those positions. It was still a surprise. I was surprised that airlines came down, but there's not one thing you can't tell me about the airlines that's negative that's not already priced in. I mean, they're at 10% capacity. They have liquidity problems. They're reported already. And the two that I like, and the one that I gave away was Southwest, they have enough money to last for the end of the year. Plus, you have the government backing them. So I see a little downside. And if they can get to 20, 30% capacity, which I think they'll do over the next 6 to 9 months, you can see these things pop 30, 40%, and they'll still be down 30% from their highs. So that's me watching everybody. That's me listening to emails that I get where I was like, you're crazy. The airlines are dead. They're not, So when I see that and there's so much negativity, that's the most important thing. And the point I'm going to get across is you want to gauge the consensus, because if you could prove if it's wrong, if they're too bearish or they're too bullish, that's how you make a fortune on stocks. It's not by buying the stuff that continues to go higher that everybody loves. I mean, in this market, yeah, okay, you got the FANG names, but most of the time it's not like that. You want to try to, get a gauge of what these guys are predicting, what they're saying, what estimates are. And I've seen stocks where, wow, these earnings are too low. They're going to explode higher. And I've seen times where, wow, this thing's going to get nailed because these guys are way, way too optimistic. So those are the things that I do. Those are services I use. And again, this is my life. This is all I do. So I love doing this stuff. Let's move on. And Bob asks, please define what is meant by be careful concerning getting back into the market. You have to be careful because if you're picking the wrong stocks and sectors, I know you're seeing the NASDAQ up, which is great, but if you pick the wrong stocks and sectors, you're going to get destroyed. So if you look at the S&P 500, and I looked last week where it was down 8 or 9%, and it was misleading because if you're looking at the biggest company, the tech weight in the S&P 500 is 25%, and it's 30% if you include Google and Amazon, which are not included in the tech part. So when you're seeing 30% that's control of the market just continue to make new highs, the whole index is going higher, right? But if you take every stock and equally weigh it, the S&P 500 was down 22%. What does that tell you? It tells you there's a lot more stocks that are down than up. So when I say be careful, you may see the market, you see, wow, it's going higher, it's going higher. It's Apple, it's the FANGs, it's the Amazons, a lot of the, it's just that weighting in all the major indices. That's why these things are going higher. But not every stock is. So that's why I say be careful in the stocks you recommend, because to be honest with you, it's a lot easier to pick off these stocks because most of them are not doing that well. If you take out technology, the index would be down 25%. So outside of technology, if you're looking at other companies, there's incredible opportunity to go short, incredible opportunity to buy puts against these stocks. And that's why right now, where you're seeing the market came back, a lot of crappy names have come back and just pushed higher alongside the market. And it's going to provide a great opportunity to really pick some of these things off that shouldn't be trading any place close to where they're trading now, especially since, travel industry stocks, outside of airlines are down. They're reflecting it. But, are cruise lines down enough? I don't know, because if you're really buying the cruises, if you're really buying the casinos, if you're buying all these things, you have to buy the airlines. The airlines are down more than these things. And how do you get to Vegas? How do you get to a lot of these places? So that's why I mean, be careful. Be careful which stocks you're recommending. Be careful which sectors you're recommending. If you're right, you're going to be very, again, technology over the past month on this rebound has been incredible, but not everything is up. Most stocks are still trading well off their highs. Let's get to Ron. A couple more questions here. Get to Ron. Ron asks, with all the uncertainty in individual stocks, is it a safer move to bet on sectors and buy ETFs? Yes. I mean, for average investors, my job is to go in. I'm able to pick individual stocks. Again, I'm not right all the time. I'm right more times than I'm wrong. And when I'm wrong, I cover if you guys listen to Wall Street Unplugged every Wednesday, which I host free podcasts, doing it for 12 years, right? 12 years podcast. Pretty crazy. But for me, this is my life. I could pick off individual stocks. I know a lot of these names even before I start researching because I researched, I have that experience. For a lot of you out there who have your own jobs, you don't. So, you rely on me, you subscribe to my newsletter to have that individual names. But overall, if you're not looking at your portfolio every single day or week, not that you have to use every single day, but ETFs are much better, sector plays. You're not going to see the big gains, right? For me, I like to look at discrepancies and, the mispricing of different individual names compared to the rest of that sector. And, that's one of my strengths where I'm able to find saying, wow, this company should be trading a much higher valuation. The index is trading at 30 times forward earnings. This is trading at 15 times forward earnings, and it's growing faster than the rest of the stocks. So for me, I look at things like that, and I'll provide tons of individual names for you. But on your own, sectors ETFs is much safer. It's going to allow you to sleep at night because in this market, even people who own the S&P 500 as a whole through this since February, they're not sleeping. Most people are like, wow, all right, it's going up. Should I sell it because this is crazy? I don't understand. I'm seeing unemployment at record highs. GDP is going to fall more. At the most, it's fallen ever. So we're looking at, again, comparing to 1930s Great Depression, but yet stocks are going higher. You just owning the S&P is kind of confusing for people right now. So, individual stocks, for me, you need someone who's a professional. You need someone who's a diehard. You need someone who loves this, that really knows what they're talking about. And I pride myself on this. And I know so does Ginny as well. So for most people out there, it's safer, yes, for sectors and ETFs, definitely safer. But if you listen to somebody good, even if it's not me, if it's somebody else, make sure you do the research on that person. Make sure they know what they're doing because you don't want to get nailed. And especially when these stocks are down, make sure they're telling you what to do with them because that's how you build credibility, right? When stocks are down, when stocks are up, nobody wants to hear from you. When stocks are down, people just want to know what to do with them. And I've known that over my 25-year career. That's how I was taught, where I pay much more focus to, the few losers that we have in the portfolio. And I'm always after you, let you know exactly what to do with them. So basically to answer your question, safe move to buy sectors and ETFs, absolutely. Let's just take a couple more. Any good growing dividend paying stocks? So I'm a big believer dividends are going to be the next growth stocks because interest rates are super low, and they're going to stay super low. I mean, dividends, a lot of companies are being forced. If you took money, they have to suspend you. You can't pay a dividend, can't buy back your stock. I'm seeing dividend aristocrats that are, companies that are used to raising their dividend for 25 years straight, annually every year. Some of them have stopped. So it's a dangerous market. I mean, Disney, right? Disney was only paying a 1.5% yield, and they said we're not doing it over 6 months. That's how bad their cash position was, and how much debt they have on the balance sheet. But this is where unlimited income comes in, and we offered a special for Money Flow Trader where we're launching unlimited income next month. It's in beta, and we're giving this away absolutely for free with a special deal for Money Flow Trader, which we're not too sure what the price is going to be, but this is going to be an awesome, awesome newsletter. Demand that I'm seeing just from everybody out there. We wanted to launch this last month, but of course the coronavirus was just too much going on. So we have it in beta version, and you have access to that by subscribing to Money Flow Trader, but nobody else has access other than my Curzio One members who are like, the big members that own everything, which is a really cool club. But so if someone calls, if you call and say, hey, Frank, how much for unlimited income? Nothing. We didn't launch it yet. They only get access to this. So what Ginia and I discussed, and I know she's going to focus on these, but even now when I look at dividend paying stocks, I want to focus on the ones that actually raise their dividend during this time. A couple of shippers. I mean, Nat was one of them. Nordic American Tankers. IBM raised a dividend. Qualcomm, MetLife, Travelers, Pepsi. Not a lot though. But if you're raising in this environment, that's really good because that means you said growing dividend payments. So it's not just buying yield. You need to buy stocks that are growing. I'd rather have a 1.5% yield of a company that's growing earnings 3 times faster than the overall market or twice faster than the overall market than a company that has a 7% yield and is growing much, much slower than the overall market, because that 7% yield is not going to mean a thing if you're down 10, 15%. You need those capital gains combined with those yields. You need to buy growth stocks that pay dividends, and a lot of technology companies are in that as well. Apple's just a little bit too expensive here, but they raised their dividend. But there's maybe a dozen that I saw, 15 so far through earnings season. Pretty crazy because you can get away with it like Disney. Disney stock went up, and they said that they're spending a dividend for 6 months. So a great way to play is just through a limited income. For everyone out there who's not a Curzio One member, subscribe to Money Flow Trader. You're going to get access to this next month when we launch it. Otherwise, if you subscribe to Money Flow Trader, then you have access to this newsletter. She's got positions in there that she's looking at. But this is what she does. She does options and she does income. It's just an amazing hire for me. And you saw her. She's great. She's humble as can be. She's not someone that's going to say, hey, I'm great, I'm awesome. No, it's not like that. She's just, here's my work and here's what I've been doing for, over 15 years. And, I'm just happy that, we have her on our team. So let's get to one more. And it's from, let me see, it's a good one. Let's go to Dan. It says, I sold out of all stocks in my IRA and 401k in February. What would be your advice for people like me currently in all cash or bonds as the market has gained most of the losses while I'm sitting out? I'm getting FOMO, fear of missing out. I answered this earlier. The stocks I have in my newsletter are doing fantastic. We were just selective. We picked away at some of large cap industry leaders that are up a lot, that are up a ton, that I could see what earnings going to be the next couple of quarters. They're not removing guidance. So you want to get into some of those names that, and there's plenty of them if you follow my newsletters. Curzio Research provides a low price newsletter for everyone. It's large caps and mid cap stocks and different few yielding stocks or dividend paying stocks. But it's really for large caps and just finding the right names within maybe the top 5 in every industry that really look good, that I think have, 30, 40, 50% upside potential over the next 24 months with limited downside risk. We've done a good job. So scaling into this market is one thing, but you want to really scale into the names that have clarity, have certainty, not the ones that remove guidance, because that's pretty scary right now. You don't even, if you remove guidance, you don't know if you're going to be down 20% in earnings or 80% in earnings. But yet in this market, you remove God, you should get rewarded, which is pretty crazy. So, all right, guys, took about 40 minutes there to answer your questions. Hopefully you appreciate it. Lots of questions on Money Flow Trader. We're still offering that special just for a limited time, guys. That's an institutional newsletter, which we sell for $5,000. Now you can get 60% off. But if you're interested, it's fine. If not, no problem. And we have Wall Street Unplugged podcast. We have that for free. We have other newsletters that are lower priced. But this price is going to be raised considerably. I just wanted to, give you an opportunity, because if you purchase this newsletter, you're going to be with us for a very, very, very long time. That's what I care about. I'm here for 10, 20, 30, 40 years. I've been doing this for 25 years. I'm not going anywhere. I would do this if I didn't get paid. So for having access to this type of newsletter in this market is really, really essential. That's why I've been pushing it. And I think you guys are going to do very, very well with Ginia. Plus, you get unlimited income absolutely for free option guide. And also, if you're not a subscriber at all, just by becoming a subscriber to this newsletter, you automatically get access to my Frankly Speaking podcast, which is a Q&A podcast. I'm not going to answer this many questions, but it took about 20, 25 minutes to answer four of your questions in detail, only from subscribers. So it's exclusive just to subscribers, which is a really cool service. The feedback that I've got when I pulled that off of iTunes is unbelievable for my subscribers. So thank you for doing this so much. It's really cool. And I could just focus on, my paying subscribers, and answer your questions. So any more questions or comments? I'm here answering a lot. Took over an hour on last Thursday in our town hall, and 40 minutes now. But thanks for joining me. You can find us on Wall Street Unplugged or Curzio Research YouTube page. This is getting taped, and we'll send you links. But thank you so much for writing in. And I'm going to try to answer. It's very busy. It's very crazy, but I want to try to answer a lot of these questions individually. As you know, I can't give personal investment advice. I could speak to an audience like I am now. So if it's about, Frank, what should you do with one of the stocks in a portfolio? I can't answer that one-on-one. I have to answer that to an audience. But there's a lot of questions that aren't asking that. I want to try to get to them and try to answer them, since you took the time to actually ask me and watch our town hall event. So guys, thanks a lot. I'm here for you. If you need anything, email me, frankcurzioresearch.com. And I'll report back to you guys soon. Take care.